We have Len Yates on here from Option Vue, Systems International. We're going to be talking about some recent changes and updates in the modeling and so forth, some challenges we've been having, and the future plans and what to expect from Option Vue in the future. Before we get going, naturally, everything here that's shown is going to be hypothetical computer simulated trades. So make sure that you're aware of that. They're not even meant to reasonably represent anything live. So this is Len's contact information. So make sure you can go ahead and do that. And also I have my contact information on here as well. Len, you have a slideshow, right?
I've got a couple of slides in PowerPoint, and the rest of what I want to say we'll be using Option Vue Live. Okay, great. So I am making you presenter. And if you'd like, you can share your screen. You should see a screen share button there. Okay, I see it. Okay. So ladies and gentlemen, here's Len Yates. Okay, thanks everyone for coming in today. This has been a tense week, and I feel a bit rushed. And today's presentation is not going to be very polished because I didn't really feel like I had much time to prepare. I've been digging into the problems that we've had all the way up until just half an hour ago when I decided I better get ready to present. But I'd like to start by giving you some good news. We may have found the problem or the main problem that's been bothering us all week. And if you can see my program, I'm going to open the model volatility screen for the Russell and show that these CEV numbers have been 1.0 for most of us starting early in the week sometime. I don't know exactly when, but we seem to have some kind of a problem computing and communicating down into the Option Vue program good CEV numbers for the Russell. Until today you can see good ones. These are good numbers. This 0.8, 0.824 and so on are good numbers. And with these good CEV numbers, I mean, that has a pretty big impact on the model. And I talked to one person. I've been in contact with Jay Winger for a couple of days now, quite a bit yesterday and then this morning. He was one person who had the 1.0 CEV numbers in there, and even this morning I was kind of surprised that I didn't get it fixed yesterday evening for everyone. But the odd thing is some of us picked up these good numbers when we opened our RUT matrix for the first time this morning, and others did not. But I was able to send a file to Jay Winger, and he restarted his Russell matrix, and he now has good CEV numbers. And in a short time of testing that he had this morning, he said, and I'll quote to you, I can only tell you at this point, looking back at a few screenshots, that things look better. So it's definitely a step in the right direction. I'll be able to tell you more after I return and I can do more testing. So that's what he wrote to me just a few minutes ago. And I think we may have put our finger on the main problem in terms of the Russell. And I know that the audience I'm speaking to right now, at least I assume that your positions are mainly in the Russell. So the other odd thing about this particular problem is that the Russell is the only thing that's had this problem, and that's rather stunning to me, and we've never had a problem like this before. So I think that it's just been an unfortunate coincidence that we had this problem start early this week, maybe even on Monday, at a time when everything else was shifting and unsettled. And I might have noticed it sooner, but, well, we won't get into that. I spent all day yesterday and half of the day before scouring through the code to find what must have changed between version 7.67 and version 7.72 that you see me running right now. And I found a few little things that could have had an impact on the model, although it doesn't seem like they should have had much of an impact. And I reverted them one by one. I returned to exactly the way 7.67 had that little section of code here and there, here and there. And as I checked things after each change, I was finding that it was making no difference. And at this point, I'm completely out of ideas as to what changed between 7.67 and 7.72, and I have to think that the problems we're seeing are due to some other factor, and perhaps this CEV thing is exactly it.
Len, we have some questions about how to get that CEV. I guess I got 3 people now that are saying they have the CEV that's still at 1.0.
Mm-hmm.
Do you know what they can do in order to change that?
Yeah. We didn't make a plan for today, but
okay.
Jim, I think what we should offer is that they can call in or email in and request a new file. The file that we would send is called assets.txt. Assets.txt. It's one of the daily files, and it would simply need to be copied into a certain Option Vue folder. We'll give instructions in the email where to put it, and then you would need to restart your Option Vue program. And then there's one other step. I guess we'll give these instructions out in an email.
Okay, that's probably the best thing. Yep.
And then, of course, after we're through with this presentation, my job for the rest of the day is tracking down what the heck's going on with this CEV for the Russell and get it permanently solved.
Okay.
So that's there. I think that's good news. And we'll be interested in hearing back from people as they start using good CEV numbers, how they feel at this point. Meanwhile, I'd like to move ahead.
If they have,
and what I want to do to
Len, if they have feedback for this, because obviously, you know, you guys, the more feedback you get, the better you can correct things for everybody, right? So, who do you send the feedback to? You directly, or just to tech support?
Why don't you send it to tech support? Jim will see them. Jim will filter them, look through them first, and he and I will be in contact a lot.
Okay,
about you know, how I should focus my attentions.
Okay, great. So it's support@optionvue.com, right? So that would be fine. Okay, super. Sorry to interrupt you.
That's okay. And of course, that does leave open the question of positions in other assets. What if people have your type of position in, for example, the SPX? Now, that would not have this explanation because I believe the SPX always had good CEV numbers. And I don't know whether there are any SPX people out there who could comment on how they feel. But before you do comment, I think you ought to see what I'm going to present next, because for the next several minutes now, I want to show you how the model works. You really need to see this, and once you grasp this a little bit better, I don't know, you would probably be able to see why the Greeks bounce around. I mean, you know, we all buy a car and we drive it without knowing how the engine works, and that's all we want to do is just drive it. But the engine in Option Vue is, as far as the volatility modeling, is a whole lot simpler than the engine in a car, and I can explain it to you in just a few minutes, and it might be an eye-opener for you. So that's what I'd like to do right now. In the matrix, we've got a real typical John Locke type of position with the butterfly in out-of-the-money puts in December. I hope you can see my cursor as I move it. And plus a call that's deep in the money. And the graph of it looks typical. And what I want to draw your attention to now is the volatilities. Look at these volatilities. This is the MIV. MIV stands for market implied volatility, or you could just as well say mid implied volatility. And we're showing bid ask here as well. So with the bid ask, you take a mid price, and if we expand this particular option, we can see that the mid price, or what we call market price, is 29.10. Based on that price right there, a calculation is made of this option's IV. Okay, and its MIV is 20.6 right now. And you can see that all these options have got their MIVs calculated for them up and down this row. How could you tell, I'm going to put a question out here, how can you tell whether one of these is overvalued or undervalued? Well, it would be pretty hard just looking at these numbers, but if you were to plot them in a graph, you would be able to visualize and almost instantly see which one is overvalued or undervalued. Well, that's exactly what we do. We plot this graph for you if you open Model Volatility and then go into the Vertical Skew tab, and we'll just go right to these December puts. Click that, and then you can click on showing this skew graph. And here we have plotted every one of these options for which there is an MIV measured. And each option is represented by an X here. This one I'm pointing to is the at the money. Okay, so this at the money one, if we look at the scale, is about 20.9. I think that's what we saw in the matrix, 20.9. And then as you go to the left, you're looking at farther out of the money puts, out this direction. And as you go to the right of center, you're looking at in the money puts. Okay? And right away, you can see that most of these options are fairly valued. Here's one option that's slightly undervalued, and here's another that's slightly undervalued. And then over here, with rather deep in the money puts, there's two of them that are quite overvalued because they're off the line. Okay? So we have this curve that's fit to the model, that's fit to the data, and the curve is basically a parabola. Okay, it's hard to tell it's a parabola right now because it looks almost like a straight line, but it does have some curvature to, how shall I say it, concave to the upside, and that's being measured. And with this curve, now what we have is we have a curve for every expiration and for every call and put separately, and we even have a curve for the combined calls and puts. Let's look at that one. Okay, so this is the curve for the combination of both the calls and puts in December. And this array of curves is our structure for the vertical skew curve volatility model. Okay, it tells us not only which options are currently overvalued, like these appear to be, these X's right here appear to be overvalued, and all the calls appear to be undervalued relative to this curve. I think it would be more fair actually to value the calls by themselves as far as looking at what's overvalued or undervalued. But anyway, then we use those curves then to project into the future under all kinds of different situations what will happen to the skew curve. Okay, and a lot of this is based on well, okay, now let me say it like this. Let's open up a curve. Let's get a simple graph up here. Like I said, this is the at the money. So what will happen if the market falls? If the market goes lower, then this option right here will be the next one to be the at the money. And in fact, all of these will slip down the curve. They'll scoot down the curve this way into lower volatility numbers, except that the CEV factor works against that. Then the CEV factor will say, well, the market's falling, So all volatilities need to increase, and it will push the curve upward. So at the same time that these are sliding down as the market falls, the CEV factor is going to push the whole curve upward. And it may end up that, let's say this particular option right here will end up at the same volatility, or maybe a little higher, or maybe a little lower. We don't know just by looking at this. But that's how the model works, and you can see, if you go back into the matrix, you can see the results of the curve. Let's make this be projected volatility here. Projected volatility. Okay, the numbers in this column are coming right from the curve. Okay, so and this is the number, this 20.2 right here is the number that's going to be used for computing this option's theoretical value and deltas in all the Greeks. Okay, this number right here is going to be used for computing this option's fair value in Greeks. So all these numbers come from a curve, and the curve is constantly being refitted. The curve is being refitted every time the price of the underlying updates. Okay, anytime the underlying price updates, we refit the curve. And that could make the curve shift a little bit. And I'd like to illustrate for that for you in a minute. But just to recap, so this is a process that starts right here in this column with the MIVs. And from the MIVs, we fit curves to them that look like this, okay? And then from that curve comes these numbers, which are used to compute fair values and deltas. Okay? Now let me bring up a couple of PowerPoint slides that will help illustrate. Let's see if I can put this in slideshow. I took these snapshots yesterday while I was watching the market live, and I saw it bouncing around. I had one of these kind of positions on, just exactly the kind I was showing you, the John Locke type of position. And when I saw that the delta went to kind of an extreme, as I was seeing delta bounce around, this was a low extreme. I took a snapshot of the curve that existed at that time. And this is the curve for the combined call and put skew. Then I watched for delta to kind of move to the other extreme. I just switched the slide. I don't know if you saw that. And now delta is a minus 42, and the curve looks different. And I'm going to toggle back and forth now and show you how the curve changes a little bit. And it only took, I don't know, it only took a minute or two between these two instances. Okay, so the curve can wiggle around a little bit as it's being refit and refit, constantly refit. And one thing that happened, let's see if I can, yeah, you can see my cursor, I hope. One thing that did change between these two times was the call options, and these are in-the-money calls. The in-the-money call options seem to go to a higher price. They got priced a bit higher right here. And the result of that, since the call options are being included in this curve fit, was that the line is not pulled down as much by them. When it was like this, the line right in this area was being pulled down just a bit. Okay. So now that looks like a slight change in the curve, and it is only a slight change. But that's going to make your delta, like I was seeing, switch between a negative 58 and a negative 42 in a position that's worth $17,000. It's not an unreasonable thing to see delta bounce around like that. So, you know, the model's not perfect. The model, it's not perfect, and there isn't going to be a perfect model. Okay, it's kind of like how they predict the weather.
Right. Yeah. I think that in particular isn't a model problem. I mean, the reality is, if you're deep in the money, you have a very wide bid-ask spread, and if somebody puts an order in, it's going to change it a lot. So, and it's going to shift your delta around, just that price and the option change. So, right?
Exactly.
So that's kind of normal. I have a couple of questions.
Market.
I have a couple of questions.
Well, let me just make another point.
Yeah.
So you have the market makers deciding to update the quote on these 4 in-the-money calls, and over here there was an in-the-money put, a couple of them that got updated as well. Those particular options, those deep in the monies, update less often. As I was watching them yesterday, I saw some of these not update for 4 minutes. And so I want to suggest that it might be a mistake to include the deep in the monies in your, let me get this off here. Let's look at these deep in the money puts. I've got extents on large, so we've got all of these hugely valued puts, but we're not even trying to measure volatility off of some of them until we reach a certain point. Let's put time in here. I want to see when these last updated. Now see, we've got one option right here that hasn't updated in 2 minutes. And here's one that hasn't updated in a minute. And if it was me, I would not want these stale option prices being involved in my curve fit. So
let me ask you, if you're going back trader, Len, if you go in back trader, are those all current?
No. When backtrader takes a snapshot, if there's a particular option that hasn't updated in 3 minutes, let's say, then it takes that price and puts it in there.
Okay. I was just wondering, because we get different Greeks sometimes in backtrader than we do in live. It's just something that we notice. I didn't know if that was why.
Yeah, I'm not sure what to say about that.
Okay.
But if it was me, I would lower my extents, especially these ITMs, the in-the-money calls. I would go down at least to moderate on both the calls and puts.
Right. Some of the things, some of you may not realize, if you change the amount of strikes in the matrix, you actually change the number. The calculation is different for your delta because you literally don't.
Yeah, it changes everything.
Right.
Yeah, let's put these all back on large, and let's have a look at the live curve for combined December. All right, and maybe I should take a snapshot. Let me take a snapshot of this so we can compare. Let's get this. All right, now move that to the background. Now I'm going to hold on. Wait a minute. What's causing these? These are out of the money calls, and those are kind of a problem. The in the money puts are not really causing much of a problem right now. But let me just, for illustrative purposes, I'm going to remove these out of the money calls.
Here's the issue we have, right? Is that out of the money call thing is real, right? And that being the case, you need that affecting your T+0 line because it'll show on the graph.
Okay, no argument there. No argument there. But here's the point I want to make. Let's go ahead and take away. Let's make this moderate and see what we get then. So we've taken away quite a few of the out of the money calls. All right. Now look at how well the curve now fits the puts that we have positions in. We have a position in this put, and then 1, 2, 3, 4, 5. This put. This is the center of our butterfly right here. 1, 2, 3, 4, 5, and we have the wing. The outside wing is here in this option. Now that the curve is fit better, you have two things. You're going to have better Greeks, and you're going to have more stable Greeks, because this line is not being pulled around by the call. Some of these calls were way up in here, and by the way, the model kind of knows how I put.
Yep, Len, we lost you.
Can you hear me now?
Yep, you're back.
Oh, okay. I have programmed special things into the model long ago, and one of them is when it sees a certain small number of points that are off the curve, it can disregard them. So it has that ability. It looks like it's disregarding the few out-of-the-money calls that we've left here, and it's decided to make the best fit it can on most of these points over here. So let's go back. Let's bring back the illustration of what it was. Here's what it was. Where with this end of the curve being pulled up, this area right here was being flexed downward. I don't know if you can see my little dot here. Oh, okay, here we go. This area of the curve is flexed downward with the result that we're going to be evaluating these puts you have positions in with slightly lower IVs. So again, I would suggest lowering your extents so that you get a better curve fit. A better curve fit is bound to lead to better Greeks and more stable Greeks, and a better T+0 line as well. You won't see that T+0 line be off of the dot.
You know the issue that we're having, and as you're talking about this is essentially what's coming on. The thing is your T+0 line, if you don't combine the call and put skews and you're just looking at the puts, right? Your T+0 line is going to model the puts. The problem is the actual price or your actual profit and loss reflects the calls. So
I'm not sure what you mean.
Well, what I'm saying is if I'm sitting there in my position and you're modeling only puts, you're going to have a flatter delta and a flatter T+0 line, right? It's going to be one set of Greeks. When you bring the calls in, you get a different set of Greeks. Theoretically, they should be the same, right? And theoretically, they should be the same. There should be no difference between your calls and puts, but there is. And it's a fairly significant difference, at least since 2013. So that being the case, to actually get a good projection of what your price is, what the profit and loss in your position is going to do when the price moves up, you need those calls in there to actually push that line down, because you need that line pushed down. Otherwise, you're not getting a good projection. So I think the answer here is just for us to change the way we do things on my end to deal with your new modeling stuff, so that we're basically doing irons instead of put butterflies, so that we do not have those in the money puts. I mean, from a trading perspective, it doesn't matter, but if it's going to be an issue from a modeling perspective, it's easy enough for us to just say, you know what, we're just going to use calls up there, and we're not going to worry about it. Because the actual profit and loss is actually going to track the call price better. You know, whether we're going to want to combine the calls and puts after that, I don't know. But if it's causing, I don't know why it's causing an issue all of a sudden. I mean, we've been doing this since 2006, but all of a sudden it's causing this issue for whatever reason. And I mean, that may be an answer to that, because we do need that curve. The curve you're saying that the calls are causing, we need to have that in our analysis. Otherwise, we're not going to get an accurate projection on what the price is going to do when it moves.
Well,
those
okay.
are my thoughts.
And I'm going to try to address that with the model changes coming up. But let me hold that for a few minutes while I finish just a couple more points.
Sure.
And that is, I want to say, it looks like today, right now, we have these points practically overlapping. I think that's a little unusual, and yesterday it's not what I was seeing. If we bring back the snapshots that I got from yesterday, you can see that the puts were being valued at, I don't know whether to say significantly higher, but valued higher than the calls. So the put IVs were higher than the call IVs. And the reason this happens is probably the ES futures, probably not the Russell futures necessarily. the ES futures are so dominant in the marketplace that they have an influence over all the index options, and even an influence over the SPY options and QQQ and so on. And whatever bias that they're reflecting, for example, let's see, the puts are valued higher IV here. Which way would the bias be? I don't know which way the bias would be, but it's like the ES futures were expressing a certain bias, maybe only a couple of points higher or lower, with respect to their the fair value in terms of the index itself. I don't know if that makes sense.
So if I'm just kind of throw this back to you, you're basically saying that you're taking somehow something to do with the ES futures and you're calculating it in to determine certain things on this graph here.
No, I'm not taking the price of the ES futures into my model, okay. Unless with your SPX matrix open you include the ES futures, which you should do with the SPX matrix. You should include the futures, and then yes, I am taking calculations into account. But here, where we're just trying to value these Russell options based on the Russell itself, and we're seeing something that is a little odd, which is that for any particular strike, the put IV is higher than the call IV. Okay, and I'm just telling you that is almost with certainty because of some kind of a bias in the ES futures, either a positive or a negative one. I can't figure it out right now on the spot,
okay,
whether it's positive or negative.
You're saying the ES futures are affecting the volatility in the Russell options.
Exactly.
Okay.
And this is nothing but a picture of the options MIVs. These X's are the puts, and the pluses are the calls. Mm-hmm. And this is just a plot of the MIVs. Okay, so there's that point, and what was another point I wanted to make? Oh, yes, I remember now. Let's go back to this because I'm going to toggle between these two, and show you. I want you to notice how this extended tail up here wiggles. See that wiggle? It can exaggerate the effect of Greeks changing or flipping back and forth if you have far out of the money puts. These are puts, and if you have some position in the far out of the money puts, the way the model works, the tail can wiggle a bit more than the interior section of the curve. You see what I mean? Uh-huh. It's like the end of a whip or something. So there's that. Okay. Anyway, and now I'd like to talk about the fact that I am working on a better curve fit. Let me just stop and say, I've appreciated the contact that I've had with John Locke and others in the past few days here, and I understand much better now than I did before how the trading strategy you're using is based on a lot of back trading, and you said hundreds of hours of back trading with the model as it is, and you hate to see the model change in any way because it means your foundation is shifted and you might have to do all that back testing over again. And so with that in mind, we certainly want to be more careful. And we absolutely have learned in the past few days that we must not make a change to the model whatsoever at the same time as something else very significant in the program makes a change, and especially a change that causes a mandatory upgrade. I've learned a lesson from that, and we'll never do that again. So please accept my apology for trouble caused, and there's no way of going back to 767. We've got to go forward from here. I gave very strong thought to that yesterday, and I found there's just no way of going back. It would be a huge mess. It'd be worse than things are now. And I think you just got to believe me. We've got to go forward from here. And I do want to go ahead and make the model better with a better curve fit, and I realize what that's going to do to you, but I think it's right to do it. Let's just bring up a curve here. Let's bring up something closer, because nearby curves are worse. Yeah, okay, this is all right. Now let me just remove that line for yesterday so that the graph is clear. All right. When I look at this, I don't see a good fit. I see an okay fit for the options in this area here, but we're not fitting these out-of-the-money calls very well. And this curve and this smile is here in a lot of the indexes. This curve, this smile is not there in a great many stocks, but it is here in the indexes, and perhaps some of the ETVs, although I was checking the SPY the other day and it does not have this curl this upward curl. But anyway, the indexes do, and I was trying to make a better model, a better fit here when we came out with 7.70. I spent a lot of time working on that. We thought it was working well with testing in-house, and then we found after we released it, people started screaming that it was unstable. Well, not a lot of people did, but a few did, and that's when we felt like we had to retract that and return to the model that was in 7.67, which we did in the release that's out now. And I've already begun working on a totally different approach to making this curve fit better, and I think it's probably going to work, but it'll take me about 3 more weeks I want to allow about 3 weeks more before coming out with that change. And when we do, there's two things that we're going to do differently. One, we're going to have beta testers. We've been satisfied with alpha test all these years where we just test it in-house. There's 4 of us that bang away on it for about 2 or 3 days before a release to find any problems before release. And we will still do that. We will still do the alpha test, but we also want to have a beta test period now of, I want to say, 2 or 3 days. We don't want to make beta test extend for too long because we like to get improvements out to people. And we would want to select only a few beta testers. We don't want a whole gob of them. I think that 20 or more would be way too many, hard to manage. So I'm thinking something like 3 to 6 beta testers would be good. And we've already had a few volunteers, but we wouldn't mind having a few more volunteers come in. But you might not get selected. I just want to warn you, because I don't think we want to have any more than about 6 beta testers. So we'll have that beta test period. And the other thing is, when I come out with this next model change to try to achieve a better curve fit, then I also want to try to put into the software a switch for you to be able to flip back and forth between the previous model and the new model. And that will, I think you'll appreciate having that. For one thing, it will allow you to put off your start of doing the study of backtesting again, if you have to do that. This way it'll allow you to be able to do that when you're ready, when it's a good time for you. See what I mean?
Right.
You can stay on the old model.
Plus you can compare models too, which would be very useful actually.
Right, and then comparison would be the other thing. But I really must insist that a better curve fit is what we all need, because a better curve fit means better fair values, more accurate fair values, more accurate Greeks, and more stable fair values in Greeks. So that's definitely a goal of mine. So I think that may be just about all I planned on saying. So at this point, are there any questions?
Yeah, can you see the questions, or would you like me to read them?
I'd like you to read them if you don't mind.
I don't mind at all. It asks why your model screen is not showing the small numbers on the side of the CEV model, like the 1, 5, and 10, like the new systems do.
Say that again?
If you go in your model screen,
mm-hmm.
We have volatility next to the CEV. Where's the CEV?
To see the CEV, you have to click on the horizontal skew tab here.
Right. So if you look at the CEV chart you have there, the little chart, all our models have, not the chart, but the little matrix. Right. All our models to the right of that have a 1, 5, and a 10, where you can switch between 1, 5, and 10.
Oh, yeah.
I don't know what that means, and I don't know why you don't have it. So.
I don't either right now.
Okay. Well, good enough.
I don't know.
All right. So how do we know the IV in the graph is derived from where the options are actually trading?
How do you know that? Well, I don't know how to prove it to you, but they're directly translated.
Yeah, okay.
These numbers go straight into the graph.
Right. They go straight into the graph, and I think also too we have because sometimes the options are different than they show on like a thinkorswim platform or something, the IV numbers, and I think it's because, and correct me if I'm wrong, but the thinkorswim's showing you the actual IV of the option, and you have a calculated IV that's theoretical, right?
Well, no. Whatever thinkorswim calls the IV, that would be the same as what we call the MIV, this column here, which is calculated right off of the options price, plus the other factors like the price of the underlying and so on.
Okay, because I think people have noticed they've been different. So, and remember last night when you were talking to me, we were showing two different IVs. We were showing one IV, which says the actual option IV, and then you were showing another IV, which is something that was calculated.
Oh, and yes, we're doing that right now. This is the calculated IV, this projected volatility.
Oh, okay.
This represents the curve. This is, in a sense, a tabular picture of the curve.
Okay. All right, so that's what
these numbers are.
And the other ones would be the actual numbers. Okay, interesting. All right, great.
Mm-hmm.
All right, what does CEV stand for?
Constant elasticity of volatility. And a CEV number that, without going into all what that means.
And one's like infinity, right?
Yeah. No, 1.0 means there is no CEV effect.
Okay.
That's kind of numbers below 1, like these are, mean that when the underlying falls, options become more expensive. Their IVs go up. And if the underlying goes up, the IVs go down. So there's that inverse relationship.
Okay.
And that's what a number less than 1 means here. And the more below 1 it is, the more intense that relationship. So naturally, the nearbys respond quicker and faster to a drop in the price of the underlying or a rise.
Right.
Okay. Than these farther out ones, 1 year and 2 year. They don't respond as much.
Would that be more, in that case, more useful if you're doing like time spreads, like calendars and diagonals?
Oh yeah, the difference in CEV numbers by term.
If you increase your CEV value by actually making the CEV lower number, is that going to change I guess we don't have control over that anyway, but that's going to change a lot with calendars and stuff. I would think it'd be most pronounced.
Yes, it would have an important effect on the calendars, yes.
Yeah.
And no, I've made it so that people can't change them anymore, not for any particular reason except that just I don't think that people were
they don't know what they're doing,
changing,
right, in general.
Yeah, they really wouldn't have a reason to change it or know what to change it to.
Right.
So we made them they come straight from our server right into your program, and that's it. And we recalculate these. The server recalculates these every week. And they're based on, I don't remember how many years of data. I'm going to say about 4 years of historical data is what these CEV numbers are based on.
Okay, interesting.
So that's why it doesn't need to be updated any more than, let's say, once a week, because they only change very, very slowly.
Okay. Well, we have a couple more questions here. Is the correction in the new asset text file for the fix for the CEV only, or are there other corrections that are in the file?
That corrects only the CEV for the Russell.
Right, that's what I thought you said. So
all the rest of the data is the same.
Yeah, and he's just asking if you just delete the asset file, will it fix the problem if you restart the program?
Well, you're going to need to pick up if you see CEV numbers of 1.0 for your Russell, then you need to write in and get a copy of that assets.txt file from us, and we'll include instructions on how to apply it.
Right, and you'll update it tomorrow or something, right? So or they can wait, I would assume.
By Monday, all of this should be straightened out, because I'm sure I'll get to the bottom of the problem.
Okay, great. So the question is, should we include the Russell futures in the Russell matrix as well? Will that give you better Greeks?
I'm not sure how the Russell futures act nowadays, but a year ago when we were trying that, and we were hearing from customers who tried including the TF futures in there were problems. I think that the TF futures were not priced right. There was something weird about the pricing, and which is not too unusual actually for futures exchanges. On items that are not heavily traded, it can be problematic. So these days, we're kind of recommending that people leave the futures out of the RUT matrix.
Okay, good enough. I don't even know if I included them or not. I imagine by default they're probably off for the RUT matrix. Is that the case?
Yeah, by default they're out. They're out of there.
Okay. And then it says, I don't understand why ES futures affect the Russell IV projection. Can Len explain?
It's not that they affect the IV projection as much as they first affect the MIVs, okay? Because they cause, let's say the ES futures suddenly make a move down. That's going to cause all the RUT puts to be valued a bit higher, while the calls are valued a bit lower, okay? And then if the RUT itself hasn't moved, that will cause the MIV of those puts to go higher and the calls MIVs to go lower. And then we refit the curves, and then we come up with our new projected volatilities.
Right. So I mean, if I had to regurgitate that back to you, you're just saying that the way in which the SPX moves in the futures, it's going to affect the fear in the Russell market as well, because generally the SPX is going to be the main indicator of which way the market in general is feeling.
Right. Yeah, it's like the pull of the moon on the tides. The ES futures have an effect on everything, and it's pretty fast. I mean, pros have set up their systems to incorporate that, and so repricing happens really fast. It's practically instantaneous, I think. There's something I meant to mention as well. There have been some complaints about how slow prices update in the matrix. And this will happen if you're working with IB, if you're getting your quotes from IB or from TOS. Both of those interfaces are kind of primitive, if I may say so. That the one with TOS is DDE, which is a 20-year-old technology, and the interface that I had to program to for IB is it's a real cluster mess up. It's unbelievably difficult, and the point is, I can only request 100 symbols at a time with IB, and I think the limit for TOS is 150. That's really limiting, and it caused me to have to program in a rotation to where, okay, we're requesting this 100 symbols, and by the way, then we have to wait for them to trickle in because we don't get answers instantly. I think the wait time, I need to look it up, but something like 5 to 10 seconds after we ask for one batch of 100 symbols. Okay, we wait 5 to 10 seconds for the answers to trickle in, and then we say, okay, now never mind those symbols, here's the next 100 symbols, and so on and so on. So it can take, shoot, if you have a full matrix with extent set on large, it might take you 2 minutes to get all the option price updates from IB. And then there's the quotes display too. That gets cycled in. If you have a lot of symbols in your quotes display, it's going to take, who knows, a half a minute or a minute to get through your symbols in your quotes display, and then it comes back to your matrix. Right. So two things we might want to suggest about that. Well, 3. I would suggest always trimming down the number of symbols you've got in your quotes display and just getting rid of ones that don't matter to you anymore. Just constantly doing housekeeping. That's what I do. The other possibility is to simply close your quotes display. If you close your quotes display and just leave the matrix sitting there working, then you're going to see faster updates in your matrix because it only needs to cycle through those options, okay? And then the other thing I would suggest is, once again, lowering your extents so that there's fewer options involved in your matrix that you're not even going to trade, they don't matter to you. They might not even matter to the model. Here, if we look at these, well, never mind that point. Yeah, I guess I've made my point. So.
Okay.
Yeah.
All right, so you might get different Greeks, live Greeks, if you're on TOS or IB than if you're on Quote View, because just from updating speeds.
Oh yeah, and you're going to have one clump of options updated now, 10 seconds later the next clump, 10 seconds later the next clump, and each time it's refitting the curves to the data where some of that data is fresh and some of it's 2 minutes old. So that's definitely going to cause your Greeks to fluctuate more. Right.
Okay, great. All right, so I just a comment here. I think a longer beta test period would be advisable. I believe we would all rather wait a little longer for improvements and know that there are no instabilities in the new releases rather than having a catastrophic improvement like last time. But then he's
okay. Okay, I take that to heart, and I would say yes. If we're talking about a change to the model, yes, let's allow a week at least. That makes sense. But if all we did was change some other things that couldn't possibly change the model, then maybe 2 or 3 days is sufficient. How does that sound?
Yeah, I think if it's not model related, I don't personally see a problem with it. So,
right.
As long as it doesn't crash the program and we can't use it for a day, that would be bad. But other than that, I'm good. All right. Thanks for the background and modeling. It was very helpful. Just an observation, looking at the IV curve, it would seem that a higher order polynomial would be a better fit than a parabola. Okay.
Yeah, and that's exactly what I was trying with the approach I was taking starting about 6 weeks ago and culminating with the release of 7.70. I did go to a higher order polynomial, and it seemed good in most circumstances, but then there was the 5% or 10% circumstances where it did weird things. And I tried compensating for those weird things, and I don't know how many hours I spent trying to salvage that approach before I finally decided to scrap it and go back. And now what I want to try is simply shifting the parabola. Okay. Mm-hmm. And that will introduce only one extra variable, and it's a simpler approach, and I have high hopes that this will be a success.
Yes, let's hope that will be better that way. All right, so let's see. Just most of these have been answered. I believe TOS now supports RTD. Are there any plans to update your interface?
Yeah, I first heard that maybe 3 years ago, and every time I go out on the web to look up information about RTD, I can't find a thing. And I have no contact at TOS itself to ask me, to ask about RTD. And so that's kind of a roadblock there.
If any of you guys know how to interface with RTD, let Len know so he can deal with it. Right?
Yeah, please.
Yeah, send that forward to him, because if it's going to update faster for everybody, that would be fantastic. Okay, so, and I think any information like that might be helpful to the software to improve whatever, I think it would be good to send that to them so they know. If you're just thinking about it yourself, they may not necessarily know what's going on sometimes. So, all right, if we only trade RUT, what should symbol limit be set to on TOS interface?
It doesn't matter whether it's the RUT or anything else. The symbol limit on TOS, we recommend being about 150. I guess you can change it, right? Let me have a look here. We go to TOS. Yeah, it is changeable. We recommend no more than 150 because I don't know what happens when you make it larger. Go ahead and try it larger. I'm not sure what to say. Jim would probably have input on this that I don't. So
yeah, let me make sure he's not muted, or I muted him because he asked to be, but he's not muted now. Would making the symbol limit smaller help performance?
No, that would hurt performance. You want as large of a batch as possible of options being updated at a time.
Okay, super. And then the last question I have right now is, how do you close the quotes display without closing Option Vue completely?
Okay, I'll show you. See my cursor? I'm going to click on this red X. That's it.
Okay, great. And really, if you only trade the Russell, you only need the Russell on your quotes display. You don't really need anything else, right?
Right.
I didn't know that changed speed and stuff. So.
Yeah, if you're working with IB or TOS for quotes, closing your quotes display can be a help, because now your options now the program only needs to work on updating the options in your matrix. And if you want your quotes display back, you see my cursor in the upper left?
Yeah.
You just do window quotes display, and it's back.
Oh, cool. I am going to try that one, because that would be helpful.
Okay.
Super. All right. Well, I think that's all we have. So I don't have any last words, or.
I appreciate that people have been patient, and I'm glad that we're working more closely together now. It seems to me that, I've been more involved with customers. Periods of time go by. I don't know, months go by, and I have very little contact with customers. People here do, of course. Jim does, and all my staff. I have a really good staff. And they take care of your needs, but this particular week and week and a half has been a time of me getting directly involved, and it's good. I see it as a partnership, me and my customers working together, and I'm glad that my customers have been patient with this situation. And that was going to lead to something. It just escaped me.
It's okay. While you think, Jim Graham just sent me a note that thinkorswim locks up if you put too many symbols in it in the quotes display.
All
So
right.
that's probably why you guys.
All right, there you go.
Yeah.
Okay, I know what I wanted to say. I want to say that the investigation is still open. We want to see later today whether people feel that getting the proper CEV numbers into there clears up the problems that they're having. And you know, Jay Winger told me that he'll have a chance to look at it more carefully later. And anyone listening, of course, can request that file and get those numbers corrected. And then I'm interested in hearing from you whether you all feel that things have gone back to normal. And I sure hope they do.
That would be good. That would be good. And like I said, we do have a model change coming up. So you know, when that's released, we'll just work with it, and and I'm sure we'll all work through it. So we're all trying to get in the same direction here, I think. So all right. Well, I thank you for joining us and letting us know what's going on, and keeping us updated with the model. We have a lot of people trading an awful lot of money here, and we rely heavily on your software. So we appreciate that. Appreciate you coming on and doing this for us.
Okay. Well, I'm glad I did too. So thanks for having me on.
Okay. Thank you. And like I said, anybody who has any questions regarding the seminar, you can contact myself or Len or Option Vue support, and we can make sure that we get what we want here. All right. Thanks, everybody.
All right. Bye-bye.
Bye-bye.